You are complicating trading too much, some with too much theory, some with too many indicators, or with the chart being overloaded of useless stuff. After this video, you are going to see trading like you never did before, and hopefully that will reflect on your results. Truth is, profitable trading is simple. So let's jump into the video and see why. An uptrend is a market that forms higher highs and higher lows. It basically means that each swing high that forms is higher than the previous swing high, and also, each swing low that forms is higher than previous swing low. A downtrend works in the opposite way, where the price action is forming each swing low, lower than the previous swing low, and also each swing high, lower than the previous swing high. The simple premise of the uptrend is essentially favoring buying positions because traders expect the market to continue like it has done each time the swing highs keep breaking while swing lows being maintained, and the downtrend favors selling positions, traders essentially expecting a continuation of what the market has done until that point. So basically, they are expecting the price action to keep going down. These two types of approaches are done by trading with the trend. And a consolidation is mainly a market's price action that lacks opportunity for both buyers and sellers. The market being in a somewhat confusing state with unclear projections, it is simply defined by a market that does not form new swing highs, but at the same time also does not form swing lows. Now, to understand better, the trending markets are the uptrend and downtrend. The consolidation is not a trending market, and the two trending markets have two types of movements: an impulsive move and a corrective move. An impulsive move is the one that runs towards the trend. So in uptrends, the upside movements are the impulsive moves. In uptrends, the impulsive move is also characterized when the price aggressively moves to constantly break highs. So this is an impulsive, then we have a correction, which is what we will explain soon, and then another impulsive, and so on. So the main point of the impulsive is an upside movement that was on the past structure that broke the current structure and created a new structure. Very simple to understand visually. There is no need of complex theory. This can be noticed by just looking at the chart. The same process goes for the downtrend. When the price breaks into a new lower low, so when the price broke down below this level and formed a new lower low, that is the first impulse on the downtrend. Every aggressive move that constantly breaks the lows afterwards is the impulse of the downtrend. Right, so we have here this impulse, that breaks the low, and another one, and so on. Now let's get into the second type of movement, which is the corrective move, also named as a correction. A correction moves against the main trend, but without breaking the main structure of the trend. This move is also called a pullback in uptrends. The correction is the move that forms the higher lows. We have multiple corrections if you see. So each time the price forms a higher low in an uptrend, that is a corrective move. So the main difference between an impulse and correction is that the impulse continues the main trend, and the correction deviates away from the main move in the short term, but without breaking structure. So let's mark this area. Just here we can see that the market is pulled back from this high, and we came down to this level. Now, because we didn't break through the previous higher low, the market trend stays the same. It's an uptrend because we're still forming higher highs and higher lows. So this becomes a corrective move, and not an impulsive move. If the market had pushed all the way down like this, and broken through the previous higher low, then this would no longer be a correction. This would actually be a bearish impulse, which is basically then what changes into a new downtrend. So when we are trading, we are initially looking to find out which way the market is going. So let's say the market is in a downtrend because we've seen lower lows and lower highs forming. Our main goal is to wait for lower highs to form these corrective movements. And on this pullback, we are looking to sell at the high. So we want to use these pullback opportunities to sell from, and then our trade would move towards into new lows. And then we would talk about more specific details that we are going to check into the charts right now. So to make sure we understand market structure analysis, we are going to analyze this market, how it moved, and why it moved this way. This is just a surface level, so it won't be complicated. We can see a swing high to the left of the chart, a high that was never retested in this structure, a level from which the market started going down, breaking the last low, and creating a bearish break of structure. So basically, we have the confirmation that the market is following downtrend. After the break, we got a small pullback to the upside and break of the lows, this break leading to another bearish break of structure as a confirmation of downtrend continuation, and the same price action is met shortly after. Small pullback to the upside, break of the lows, bearish break of structure. Now an interesting action happened here, so the price pulled back up, retraced to the downside, and created a higher low internally. And from that higher low, the price pushes to the upside and manages to break the last internal high. So this is a reversal pattern. So why isn't the price going up from this level? Well, it doesn't have to happen all the time, because that would be too easy. This being a liquidity trap for traders to get trapped into the wrong direction. A way to avoid this is to simply do not trade against the macro trend. So this microstructure is bullish, but it does not respect the macro trend, which is bearish. It's simple to avoid this mistake. Just remember the easy sentence of riding the trend. Anyway, back to the analysis. So after setting that internal higher high, the market just instantly broke down the lows, trapping traders that believed a reversal was on the way. And of course, breaking structure as a continuation of the macro downtrend, this type of price action is constantly repeated after, and obviously, short selling positions are favored on macro downtrends. Here, for example, we can see again a liquidity trap. It has broke the internal highs, but the retrace was too weak to push to the upside. And what happened instead? It pushed to the downside, so it just followed the momentum of the past price action. There is also an internal break of structure. However, the internal structure, as we have seen mostly, has trapped traders at this time. After the price keeps following the recent price action by basically just continuing the bearish breaks of structure, we can see the increase of buying pressure that drives the price to break the last swing high, followed by a pullback to the downside, a pullback that ends higher than the last one, so basically forming a higher low from which the price pushes up into breaking the last swing high, so it basically formed a higher high. Now remember, we have a higher low with a higher high formation. What trend indicates this formation? It indicates an uptrend, and we can later notice how it continues this formation of higher lows and higher highs. So basically, the market is now running into an uptrend. And for the more advanced traders, they probably saw this demand zone. This demand gave multiple buying setup opportunities, 3 setups to be exact, from which the market got an impulsive upside movement after. Let's see what risk to reward would this trade have given. A great one. Sad enough that we missed this. But no problem, as there are endless opportunities. Back into the analysis, after that impulsive push to the upside, the price pulls back, and it breaks the internal low of the uptrend, because this is a 4-hour time frame. This could have given selling setups right at this level on a lower time frame. But as we said before, it is very risky to trade against the macro trend, which in our case is an uptrend market. And it also defended the uptrend. That can be seen by looking at how the price formed a new higher low. The market would have turned into a downtrend only if the price would have broken down this level. We can mark the higher low if you think it's easier to notice, and the higher highs are very easy to be seen. Basically, each swing high has been higher than the last one recently. That means nothing but the fact that the market is following an uptrend. For the market to turn into a downtrend, the price would have to pull back to the upside, create a lower high, which it did. But then it had to retrace down, form an internal bearish trend, to break the last swing low. So it had to essentially form a lower low, from which the price breaks down, pulls back to the upside, again forms a lower high, and of course continuation of the downtrend, which is done by a bearish break of structure to the downside by breaking the last swing lows. Now that we did not see that, instead the market shortly continued the uptrend. Here we have 2 formations. An internal bullish break of structure, but that is also an external bullish break of structure, so having formed a new higher high on the macro trend. But sadly enough for the buyers, the uptrend has gotten into a reversal to a downtrend shortly after, making the price action move like it has done in the first part of the chart, formation of lower highs and formation of lower lows, which also shifts the macro trend into a downtrend. right? So we got this change of character or market structure shift, however you want to name it, from which the market just does the same downtrend formation, with their own bearish breaks of structure like it did and saw when we first analyzed this chart. And of course, the time also comes for sellers to close their position because of decreased selling pressure, this leading to a new formation of an uptrend with higher highs and higher lows. And this is how the market structure works, a repeated action of trending moves. The second concept is supply and demand. So here is an example of what supply and demand looks like in a market. A supply or demand zone is consolidation zone before a significant upside move or downside move. Demand favors buying positions. So this is a demand zone. In a market that follows an uptrend, an area before a significant upside move is demand zone. A supply zone works in the opposite way. A supply is met on a downtrend market. So if the market is constantly going down, we would want to identify consolidation areas before large price pushes to the downside, and this is where our supply zone is going to be met. But why is this concept so important? Well, there is a theory behind the supply and demand, but it's very simple and logic to understand. The market is an auction, a constant exchange of orders, and considering this, the demand zone is usually seen as a zone of discounted price to buy a certain market. The demand can also be taken in consideration as a discount zone. This is because this is where the market took off from previously. And because markets move based on buying and selling, that shows that this area here was where a lot of buying orders gathered and took place. So that's actually what causes the market to go up like this. And on supply zones, that work in a similar manner but just in the opposite way. This is mainly seen as a premium price to sell. So if the market becomes overbought and driven way too high, traders will start selling and taking profits or start opening short sell positions because they expect the market to go down and because the market has consolidates here in the past, and loaded short selling positions that moved the price down previously. This tells us that this is one of those premium price areas that price could reject to the downside once again. And from the demand perspective, in an uptrend, if many traders notice this price range as a discounted price to buy from. If the market gets back into the discounted area, the desire of traders is to keep pushing an uptrend continuation perspective, traders looking to place buy orders to take the price into new swing highs. And the same is true for selling. We can see the premium price area, which is the zone with the most selling orders gathered in a pool of liquidity. It would not make sense to sell down lower when we can sell higher at a better price. And these traders hold a bearish view of the market to hold a continuation of new lows being formed by an impulse after the price has hit a premium price. Now, when it comes to identifying these supply and demand zones on a chart, we are going to be using individual candlesticks. A demand zone is the last candle before the impulsive move to the upside. And a supply zone is the last candle before an impulsive move to the downside. Some people do that in a slightly different way. They use the last down candle before the up move, and the last up move before the down candle. But my method I found to be working the best. So taking into consideration only the last candle before the impulse. And the reason for this is that last candle before the market took off significantly is showing the area gathered of liquidity pool. Now that we know how to analyze a market using market structure fundamentals, and also learned the supply and demand, we apply both of the concepts at the same time. So let's see what is going on with this certain market. From the first glance, we are able to see an impulse to the upside and a pullback to the downside, the pullback leaving us with a swing low, and we can check that this is a higher low. This is the previous swing higher low, and the market formed a new swing higher low. So remember what we said in the first minutes of the video, specifically the formation of an uptrend. The uptrend is formed by constant swing higher highs and swing higher lows. And we can apply this knowledge into this chart. The market being followed by a small push to the upside, a small pullback, and an impulse upside movement. This was the internal structure. However, if we care about the swing structure, we can mark the market in this way, and essentially it created a new higher high from a bullish break of structure. So as we said before, it respected the formation of an uptrend, And now we apply what we learned about supply and demand. The first question we need to ask, what is the main trend? We validated that we are in an uptrend. And on uptrends, we look for demand zones. We do not look for supply zones on uptrends. Be careful. And where do we look for these demand zones? We look for demand zones on the last impulse before the push to the upside that has led to a break of structure. And that must be near the higher low formation. And if we check the last candle before the impulse, we are able to see a valid demand zone. And now let's continue the analysis, because shortly after, the market formed new higher highs. And the most important part, it mitigated the demand zone. This demand zone has given two opportunities for setups. One here, and the other one at the beginning. And here it almost touched the zone, but it did not hit. Let's also simulate the setup to see the potential risk to reward. Obviously, the entry at the top of the demand, stop loss below the demand. And for take profit, we have multiple options, such as placing the take profit right above the past swing high or right above the new swing high. And in both cases, it gives us a massive risk to reward ratio. However, I would say that this risk to reward is way too high. In this case, what I would do is to take partial profit. So for example, at this level, I'm closing 20% of the position. At the next level, another 20%, and so on. And what can also help is placing the stop loss into the entry level to secure some profit and to make sure that we do not lose whatever we made. And the impulse formed by the demand zone pushes the price all the way up into constant higher highs and higher lows with their correspondent breaks of structure. And where would the demand be in this case? Well, same as before, near the higher low formation. The demand is the candle before the impulse, and we can see that in this case the demand has not been hit. It's fine. This is what will happen most of the times actually. What matters is that we get into those few opportunities and squeeze as much profit as we can, and for a simulation, let's see the risk-reward potential on this setup. Of course, if the price would have hit the demand, a great risk to reward. Anyway, if we move on, we also see how the uptrend continues by making another swing higher high. And this process repeats. We look for demand zones. Look for setups to take the price higher. And it's that simple. On another analysis to cover this topic fully, initially this market was macro consolidation and a micro-small uptrend. We can see how it moves up and down with slight upside momentum. All of that until the market pushes to the upside from an impulse and breaks away the consolidation, followed by a small pullback that forms a higher low, followed by a break of the higher highs. So that means that we got a bullish break of structure. And again, the same price action pattern repeats, pullback to the downside, push to the upside, that leads to a break of the highs. So a new higher high formation, therefore a new bullish break of structure. Now here it is where we need to pay attention. So the price goes down, and it has managed to break an internal low. This being the first indication that the market could soon reverse into a downtrend on a micro scale. That is what the internal change of character means. And soon after we get the reversed price action that we got on the uptrend. So we got lower highs and lower lows formations, especially internally. So now the breaks of structures are to the downside. But right where we are analyzing the price action, the market is still in a macro uptrend, but has reversed into a micro downtrend. It's up until the following price movements, where the price pushes to break lows, pulls back to the upside, does not manage to break the last highs, and instead it breaks the lows again. These lows are important because these are the external swing lows. So now that these are broken, the market has validated a macro downtrend also. And if we move on the right to see the future price action, we can see how it played out. Just remember that on downtrends we create swing lower lows and swing lower highs. And the impulses are to the downside. So in this case, we look for supply zones near the source of the impulse. And that source of the impulse on a downtrend is the previous swing or macro high, and that should be near this level. And if we mark the candle that happened before the impulse, that is the supply zone. And we can clearly see how the supply has been respected, price basically pushing into the supply and rejecting down into another downside impulse. That new impulse breaks the last lows and therefore forms a bearish break of structure. but externally, so on the macro trend. And let's simulate the setup. A great take profit with a good risk to reward ratio. Market efficiency and market inefficiency is another important concept. This theory suggests that the market trades in two different ways. It follows an efficient price action, or it follows an inefficient price action. An efficient price action is basically a market that is constantly moving either up or down, but retesting every demand zone in an uptrend or every supply zone in a downtrend. So you can see that in this phase we have pushes away. Then the market formed demand zones, and the market comes back to retest those demand zones. So there was no open gaps left in price. Every time we form a demand, we pull back, and we retest that demand. Now, an inefficient price action happens where we start to form open price ranges like this here. So you can see from this movement the market has formed a demand zone. Then we had an impulse away from the demand zone. So we know that the market is following an uptrend. But the market has not yet come back to retest that demand. So this basically leaves us with what we would call an imbalance, or an inefficient price range, or an inefficiency. So this open price move here below this low is going to be the imbalance or the inefficiency. And when we see inefficiencies like this, there's a high probability that the market will fill the imbalances at some point in the future before continuing with the significant movement of the trend. What we see right on the left on the chart is an efficient price action, meaning that the market is balanced and gives fair pricing to both buyers and sellers. And that is often seen by a price action that wicks up and down. So when there are too many candle wicks, and this becomes harder to trade. But great enough, the market has broken all of that boring efficient price action and has pushed with an impulsive move to the upside. We mark the analysis so we don't forget the levels. So after forming a swing high, the market pulls back down and pushes to the upside again, breaking the highs and essentially creating a new higher high, therefore another bullish break of structure on the macro trend. Now, if the uptrend would have continued, the price action should have looked something like this. Pull back to the downside. That doesn't break the last swing low. But the pullback closes above the previous higher low, so basically forming a new higher low, and then of course an impulse to the upside to break the highs. But this is not how price action moved, but instead, the price has broken the last swing low, so it basically has formed a new lower low that is indicated by a bearish change of character or a bearish market structure shift. So now the downtrend has been validated. If the downtrend continues, the price action should look something like this. Pull back to the upside. Break of the lows. This action constantly forming new lower highs and new lower lows. Now comes the concept of inefficiency, also called as an imbalance. Notice how this zone is empty of price action. This inefficiency is indicated on a 3-sequence candle. The first candle's low, connected with the third's candle high. And if the price action leaves this type of gap, we have validated an inefficiency. These areas can be used themselves for trading setups, or in our case, to support higher quality supply and demand areas. So, if a supply or a demand is near an imbalance, that supply or demand has higher chances of being higher quality. And we also got a second supply right here. This is the candle before the impulse. So as we said, it's valid supply. We need a couple more candles to see the imbalance. There it is. Now we have two setups as opportunities. We can sell short the lower supply with stop loss above the zone and take profit below one of the lows from the left of the chart. Now this might be a too high risk to reward ratio. It's still great, but it's best to not be greedy. The other options to reduce this to a good enough risk to reward ratio is to move the take profit into breaking the last lows that price has formed recently. And the second setup is the supply from above. On this one being higher, we can target the major lows because if the market would hit the stop loss, it is because the trend has shifted into an uptrend. So even if this is a higher risk to reward than the last one that we canceled, that is because this setup is taken from the swing highs. And now the question becomes, which one setup do I take? Well, let's try the first one that will trigger, and that is of course the lower supply. And maybe we can get into the higher supply too. Alright, this setup was clean and quick. closed in to take profit within the next few 4-hour candles. What's even funnier is that it even broke the major lows, the level where I placed the take profit initially, but was scared to hold on there. And sadly, the price action has done its thing. Being too far from the upper supply, we can cancel those pending orders and enjoy the other setup. Congratulations, you've come far into the end of the video. That means you're hungry to learn. I packaged everything a trader needs into a quick course that you can finish in the same day. Not only the technical side, but also on macroeconomics, news calendar, and a psychology book as well. Everything is on the link in the description or at whop.com/traderslab. If you liked the video, feel free to like, and see you in the next one. Have a great trading session.